Today's webinar is called Swing Trading with Volume Profile, and I will try to give you a full guide to swing trading. So the goal for today is to give you everything that you need to know to start trading swing trades with the volume profile on your own. So today we will cover the chart settings, we will cover trade entry setups, 3 setups which I use for picking my swing trading levels, and then we will cover stop loss and profit target placement. Then we'll go into position management, money management, and after that I point you to some further education. So let's start with how to set up charts for swing trading. Because volume profile is a really versatile tool, you can use it for any instrument which you like to trade. So you can trade Forex, you can trade major, minor, or cross pairs. You can trade indexes, you can trade raw materials like oil or gold, or you can use it for equities. As far as time frames concerned, I personally prefer daily time frame for my swing trading analysis. And if you also prefer, for example, 4-hour time frames, then it's also alright. And if you are more into like long-term investments, then you can also use the weekly time frame. But for me, the best one is the daily. I've mentioned volume profile a few times so far, but I haven't really introduced the indicator properly. Volume profile is a volume histogram which shows volume at price, and it helps us identify positions of big financial institutions. So if you look at the picture, there you see the volume profile. The thicker the volume histogram gets, the more volumes got accumulated at the given price, and the more volumes, the more important the given level is to the financial institution. What I like about the volume profile is that it will never stop working, because institutions will always have insane amounts of money which they need to place in the market, and for this reason we will always be able to track them using their volumes, using the volume profile. There is a free volume profile trial on my web page, so if you visit my web page there is a volume profile section, and there is the NinjaTrader volume profile pack, so we can just download it, install it, and there is a free trial, so go ahead and give it a try. So let's now move on into the volume profile settings, the ideal settings to set up your charts for swing trading. There are 2 templates which I like to use for looking for swing trades. Before you can see the first one. It's combination of yearly profile with monthly profiles. The yearly profile is the big gray profile on the left of the screen, and it shows you the whole overview of the whole year, so you can see how the volumes were distributed throughout the whole year. I think this is really important to see how the volumes got created and where the institutions placed most of their volumes throughout the year. So the yearly profile gives us the overview of the whole year, and then I combine it with the monthly profiles, and those monthly profiles show us how the volumes were distributed throughout each month. So every month there's a volume profile printed. So this is the setting number 1, or you can use this one. This is also yearly profile, again the same as before, the gray one on the left. And this time it's combined with a flexible profile. And I must say I probably prefer this one a little bit more to the previous one, because I really like using the flexible profile. The main advantage of the flexible profile is that you can look into specific areas in a chart that you are interested in. So for example, if you are interested in volumes in a rotation, then you use the flexible profile and look into the specific rotation or the specific trend that you are interested in. And I like to use this flexible profile with the 3 entry setups, which I'm going to show you now. So those are the entry setups I use for creating my trading levels, my swing trading levels. The trade entry setup number 1, probably my most favorite one, is called the volume accumulation setup. I look for this setup when there is a rotation which is followed by a trend, and inside this rotation I identify where the heaviest volumes got accumulated in this rotation area, and after that I draw a line from the place where the volumes were the heaviest, and I wait for the price to make it back to this line. I wait for a pullback, and afterwards I enter a trade which is in the direction of the trend. The reasoning or the logic behind this setup is that inside this rotation, usually strong and big financial institutions accumulate their volumes. They slowly accumulate their volumes inside the rotation. But we don't know if those volumes, if those positions, they are building up, they're buying or selling. But when there's the trend, then we know, or we can be almost certain. So in this example, you can see rotation followed by aggressive selling activity. So we can expect that those volumes inside the rotation were volumes of strong sellers. So when the price makes it back to the rotation, when it hits this heavy volume area again, it's likely that those sellers will be defending their selling positions and they'll try and push the price downwards. So this is the logic behind the volume accumulation setup. Let me show you one more example of this setup. So again, you can see the rotation, which is followed by a strong selling activity. I used the flexible volume profile to look inside this rotation. I draw a red line from this rotation, from the place where the volumes were the heaviest. I waited for a pullback and I went short from this red line. I went short at the first touch. One thing I probably should mention is that it doesn't really matter how long you wait for this pullback. I had many trades which I waited for more than a year, but still they were profitable trades. So the markets have good memory. So it doesn't really matter if you wait for swing trades for a year. Alright? So setup number 2 is the trend setup. I look for this setup when I see a strong trend in the market, and within this trend I identify the heaviest volume clusters within the trend. Oh yeah, those are daily charts, guys. Those are daily charts. All those candles are daily candles, by the way. So within this uptrend, I identify the strongest volume cluster, and from the place where the volumes were the heaviest inside this volume cluster, I enter a trade when the price makes a pullback into the direction of the trend. The logic is very similar to the previous setup. So the logic behind the trend setup is that, for example, in this picture, strong buyers are pushing the price upwards. Then they stop for a while and they accumulate another buying position. They adding to their buying positions, and afterwards they push the price even higher. So when there is a pullback to this level again, to this volume cluster again, those buyers will be defending their buying positions and they'll push the price upwards. Let's have a look at one more example. In this case, there is a downtrend. As you can see, I used the volume profile for the whole downtrend area. I identified the strong volume cluster within this trend. I draw a red line from the place where the volumes were the heaviest. I was waiting for a pullback. When the price hit the level, I went short. Alright, so this is how you use the trend setup. Let's now move on into the trade entry setup number 3. This setup is called the rejection setup. And I called it the rejection setup because I use it when there is a strong rejection of either higher prices or lower prices. Now, a strong rejection is that when the price goes, for example, aggressively downwards, then it turns and it goes aggressively upwards. This is a strong rejection of lower prices, which you see, by the way, in the picture. Strong rejection of higher prices would be the price going aggressively upwards and turning and going aggressively downwards. So I use the flexible volume profile to look into the rejection area. Into the rejection area, I identify the heaviest volume cluster within the rejection. Again, I draw a line from the heaviest volume peak and I wait for a pullback. When the price hits this level again, I enter in the direction of the rejection. So in this case, you can see a rejection of lower prices, so I'll be entering a long trade. One more example. In this case, you can see a rejection of higher prices, and I identified the heaviest volumes within the rejection, almost at the top of this rejection. Again, I draw a line, waited for a price to make it to this line, and with the limit order, I entered a short trade. So those were the trading setups. And let's now talk about stop loss placement. I believe it's very important where you put your stop loss. So here is how you determine where the ideal place for your stop loss is. As I already mentioned when I was talking about the entry setups, heavy volume areas are strong support or resistance zones. So you want to place your stop loss behind such heavy volume areas. You want to place your stop loss into low volume area or into no volume area. The reason for that is that the price should react to the heavy volume zone. If the price doesn't react to heavy volume zone, then it's time to quit. So if you look at the picture, there is a strong resistance based on heavy volumes. This is the black rectangle. This is, by the way, the first setup, the volume accumulation setup. If the price reacts to this resistance, as in the picture, then it's a winner. If the price doesn't react to this resistance and if it shoots past it, then the resistance has failed and it is time to quit your trade. So this is how you use volume profile to determine where to place your stop loss. You place it in the low volume area or into no volume area. One more thing about that is that your stop loss should not be too tight. You need to let your trades breathe. So the ideal stop loss is somewhere very roughly around 100 to 200% of average daily volatility. You can measure that by the ATR indicator, which is a standard indicator in every trading platform. So let's say that, for example, euro dollar has average daily volatility 80 pips. So you would be looking for no volume areas in around 80 pips to 160 pips from the entry point. This is not a hard rule, this is just something to give you an idea where to look for your stop loss for your no volume areas. Let's have a look at one more example. So in this case, on the left of the picture, you can see that there was a strong uptrend on the Australian dollar, US dollar, and within this uptrend there was a strong volume cluster, which is the setup number 2. This is the trend setup, and this strong volume cluster works as a strong support, so you can place a long level from there. And the ideal stop loss for this trade would be in the low volume area, which is below the heavy volume cluster. Alright, so this is how you use the volume profile to determine where your stop loss should be. Another thing I want to cover is how to use volume profile to determine the best place for your take profit. In this case, we will use the same logic as before, which is that heavy volume areas are strong support and resistance zones. So imagine that you are in a profitable trade, which is running nicely in the direction which you desire. Then the best place to take profit is before the trade hits heavy volume area, because as we said, heavy volume area is a strong support or resistance zone, and when the price hits this support or resistance zone, there is a high probability that the price will react to this zone and that it will turn, which would ruin or endanger your trade. So if you are having a position which is getting near volume-based support or resistance zone, you quit it before it reaches this heavy volume area. So if you look at the picture, again, this is the same picture as I used before. Imagine that you are in a short position from the resistance level marked in a chart, and the price is going downwards, you are in green numbers, and you are looking for a place to quit your trade. So you use the flexible profile to look into the pullback movement, to look into the area where the price was going upwards before it hit the resistance. So I use the flexible profile for this area to determine where the heaviest volumes were accumulated inside this area. As you can see in the blue rectangle, there was a strong volume cluster, so this could work as a strong support, which would endanger your trade, so it would be best to take your profit there. Alright? So this is how you use volume profile to determine where to place your profit target. There is also another way how to determine your profit target. In this case, you don't do it using volumes, but you simply adjust your take profit so it matches the risk-reward ratio you like to trade with. So first, you determine your stop loss using volumes, and then you place your profit target. So if your stop loss is 100 pips, and if you want to maintain risk-reward ratio 1, then your profit target will also be 100 pips. It will probably be better visible on the picture. So again, the same picture as before. There is the strong volume area and strong resistance zone at the short trade entry. And imagine you placed your stop loss in the no volume area. Imagine it's 80 pips from your short trade entry. So if you want to trade with risk-reward ratio 1, then your take profit will also be 80 pips, the same as the stop loss. If your risk-reward ratio is 2, then the profit target will be 160 pips. There is one more thing about the risk-reward ratio which I would like to mention. The thing is that there is no best risk-reward ratio. If you have a positive risk-reward ratio, if you look at the diagram that's the left bar, then you have big winners and small losers, which sounds very nice, but you will have very low strike rate. You won't be winning as often. If on the other hand you use a negative risk-reward ratio, where you will have low potential gains and very high losses, then you will be winning very often. But those are kind of two extremes. I personally prefer the neutral risk-reward ratio, where the potential gain is very close to the potential loss, or they are the same. But the thing I wanted to say today is that this is just simple math and probability loss. There is no workaround to this. There is not best risk-reward ratio. Either you are going to have positive risk-reward ratio with low strike rate, or negative risk-reward ratio with high strike rate. This is just matter personal preference. There is no best risk-reward ratio. Alright, next thing I would like to cover, position management. As I said, I enter all my swing trades with simple limit orders. I don't use any sort of confirmation to enter my trade. I simply enter at the first touch. So when I trade with risk-reward ratio close to 1, which I prefer, then I don't move my stop loss to secure my position. I have a hard stop loss, a hard take profit, so it's either win or lose situation. But when you trade with positive risk-reward ratio, for example risk-reward ratio 2, then you want to move your stop loss to secure your position at some point. And the best place to move your stop loss to is the reaction point. It is not the break-even point. A lot of people use break-even point, but I don't think it's a good idea. The best place to secure your position is the reaction point. A reaction point is the place where the price actually turned as a reaction to your trading level. So if you look at the picture, again, it's the same picture, then I highlighted the reaction point. This is where the price actually turned. So as you can see, it went past the short trade entry a bit, and afterwards it turned at the reaction point. And this is the place where you should secure your position to. So for example, if the price goes downwards, you are in green numbers, and let's say that you are plus 80 pips, then you want to secure your position because you want, for example, to trail your position into risk-reward ratio 2, then the best place to move your stop loss to is the reaction point. The reason for that is that the price often has a tendency to return to your entry point, to the break-even point, to retest the level. And this would kick you out of many potential winners, so it's much better to secure your position at the reaction point, because the price usually doesn't retest this area. It usually retests break-even point, not usually but quite often, but not as usual it goes to the reaction point. Another thing which I would like to cover is the alternative stop loss method. It's my favorite position management method, and it deals with a scenario that every trader knows and every trader hates. It goes like this. If you look at the picture, then you can see that I have a long level there. This long level was based on the volume accumulation setup. You can see volume accumulation inside rotation followed by an uptrend. So when the price made it back to this level, I went long. By the way, this is a real trade which I took last year, I think. And as you can see, the price went past my long level and it hit the stop loss only to turn and go upwards. So this is the scenario that every trader knows and hates, right? But this doesn't happen when you use the alternative stop loss method. Because with the alternative stop loss method, you don't actually quit your trade when it hits the stop loss. So when the price hit the dotted line marked stop loss, I didn't quit my trade. I held it. And the reason is that I only quit my trade when a daily candle closes past this red dotted line, past the stop loss. So as you can see, I have my stop loss in the low volume area. The price touched it but didn't close below it. So I held the trade and I was able to take a full profit from it. However, there's one pretty risky thing, and the thing is that the market can go crazy, right? So for that reason, you need to have catastrophic stop loss, which is sort of safety pin, and it's the worst case scenario which could happen. The catastrophic stop loss is very important to have from the money management point of view, so you know what the worst case scenario could be. I use the catastrophic stop loss as 150% of my standard stop loss. So if, for example, in this case the stop loss, the red dotted line, was 100 pips distant from the entry point, then the catastrophic stop loss would be 150 pips. And the thing with the catastrophic stop loss is that this is a hard stop loss. This is a market order which is waiting in your trading platform. When the price hits it, it's over. At first touch, you are out of the trade. Alright? This is the safety pin for your trade. Let's have a look at one more example of the alternative stop loss. Again, this is the volume accumulation setup, and there's a green line which was a strong support. As you can see, I went long from there. The price shot past the level without any reaction. Then there was the massive red candle, selling candle, which closed below the standard stop loss. It closed below the red dotted line. So at the end of the day, I quit my trade when there was the close of the day below the standard stop loss. Alright, so this is how you use the alternative stop loss. I've been using it for a few years now, and my results were much better than if I was using the standard stop loss. Important thing is that I use it only with my swing trades, not with my intraday trades. It would be pretty crazy with intraday trades, so it's better with swing trades. I think you guys should definitely give it a try. I think you will be surprised how well it works and how many trades it will save. Let's now have a look at how to deal with macro news. There is a strong macro news every day, so that's why we need to find a way how to deal with it in our trading. Since swing trades are kind of trades that are supposed to be easy to manage and not too time consuming, I personally let them run even through most macro news releases. So I don't quit my trades before the news, and I trade my levels even if they get hit during the news. This rule applies to standard macro news. The standard macro news are, for example, the CPI news or GDP news or NFP news or unemployment rate news. And if you go, for example, to the Forex factory, then those news are marked in red color. Those are marked as a strong, high-impact news. But I trade through those news because I don't want to manage my swing trades all the time, right? There is one exception, and the exception is what I call the monster news. Monster news are news that directly affect central bank rate policy. So it's, for example, rate decision, minimum bid rate and following press conference, FOMC meeting or monetary policy statement and following press conference. Those are the kind of news that can cause major volatility. They can start new trends, they can turn trades. Well, there was a very nice example today on the euro dollar. There was an ECB rate decision and following press conference. So this is exactly what I'm talking about. Crazy movement, unpredictable movement, all right? You don't want to be trading your swing trades during such monster news, but it's quite all right to trade during the standard news. So let's go into money management. Because you'll base your profit target and stop loss on the volumes, and also you'll be trading many different trading instruments. Then every trade you will take will have different number of pips. Every trade will be different. So for this reason, you need to calculate volume of every trade, so you risk the same amount of money on every trade. So for example, you risk the same amount on a 50 pip trade as well as on a 200 pip trade. All right, so you adjust your volumes for every trade individually, so the risk is always the same. This is a very important thing. Always use the position size calculator. Every broker has it in their platform or on their web page, so it's very easy to find, very intuitive, very easy to use, but it's very important that you use it with all your swing trades. So that's for the swing trading rules. I know we've covered a lot, so let me do a quick recap of the most important things which I really want you to remember from this webinar. So first I showed you the chart settings. We were talking about the instruments. You can trade any instrument which you like with the volume profile because it's really versatile. The best time frame, at least for me, is the daily time frame. Then we went into volume profile settings, where I showed you two options to set up your workspace. The first option was yearly profile plus monthly profiles. The second option was yearly profile combined with flexible profiles. If you go to my webpage, there's a volume profile section and there is a free trial of my volume profile indicators, so give it a go. Next thing we covered were the trade entries, and we covered the three setups which I like to use. First one was the volume accumulation setup. I use this setup when there is a strong rotation followed by a strong trend. Setup number 2 is called trend setup. I use it when there is a strong trend. And the setup number 3 is the rejection setup. And you look for this setup when there is a strong rejection of either higher prices or lower prices. The next thing we covered was the stop loss placement. The main message was that you place your stop loss in low volume areas or into no volume areas. Then we went into profit target placement. There were two options how you can place your profit target. You can either base it on volumes, which means that you quit your trade before it reaches heavy volume areas, which are strong support or resistance zones, or you can base your profit target on risk-reward ratio you want to maintain. So you adjust your profit target to your stop loss, so it gives you the risk-reward ratio which you want. Then we talked about position management. We are talking about macro news. The main message was that you can trade during strong news, but never trade during monster news. And then we covered alternative stop loss trick. The main thing here was that you close your swing trade only when a daily candle closes past your stop loss. And the last thing was the money management. The main message was that you want to risk the same amount of money